This one's a deep dive into a stock analysis for DataVault AI, that's DVLT. It's making a really bullish case for a $7 price target, mostly driven by a huge Bitcoin investment. So let's just jump right in. What's your first take on the analytical rigor here?
So a key theme running through this material seems to be this contrast. You have the massive upside potential, right? A 300% surge to $7, but then you have this equally massive structural change from the share dilution. The report highlights the $7 target, but then it also has a bear case warning about, 263.9 million new shares? And that instantly pushed the market cap to over $500 million. Right. The analysis clearly establishes the massive share dilution from the Silex deal, but the $7 price target needs a much more explicit demonstration of how it holds up under that newly issued share count. That's really the central structural issue we need to hit first. The material right now, it sort of treats the dilution, the fundamental expansion of the share base, and the per-share valuation target as two separate points.
Okay.
And while the $150 million injection means the total corporate pie got bigger, the analysis needs to address directly how an existing shareholder's slice still justifies $7 a share.
I get the instinct, though. I mean, $150 million is a huge influx of cash and, legitimacy.
Sure.
But the second those Silex warrants are exercised, you've got a 300% increase in the float. The market cap jumps past $500 million, immediately. So if the analysis just says the growth is worth $7 without really accounting for that extra $250 million shares, the number just feels aspirational, not analytical.
Exactly. That's the word for it. That crucial connection between the expanded market cap and the sustained per-share price, it feels implied rather than, mathematically shown. To convince a sophisticated investor, especially with a battleground stock like DVLT, you have to show the math. So we need to strengthen the valuation thesis by rigorously integrating the fully diluted share count into the forward revenue multiples calculation. This is just essential for the credibility of that $7 figure. Without it, the counterargument is simply, that's impossible with the new float.
That makes perfect sense. So how do we translate that into specific, actionable steps for the analysis?
Okay, so a few ways to approach this to make the report much more robust. First, explicitly state the estimated fully diluted share count you're using to calculate that $7 target. That has to include those roughly 264 million exercised warrants. Don't bury that number. Put it front and center.
Got it.
Second, the analysis currently hangs on management's guidance of $200 million in revenue by 2026. Instead of just stating that target, perform a sensitivity analysis. Show the reader exactly what forward price-to-sales or PS multiple is required to hit $7 a share, given the new higher share count.
That's a sharp pivot. Why a sensitivity analysis specifically?
Because it moves the target price from a fixed hope, just the statement of a goal, to a measurable outcome. It tethers it to management's performance and, market comparables. For instance, if you find that justifying $7 requires, say, a 15x PS multiple on $200 million in revenue with the new float, well, then the analysis needs to benchmark that against other high-growth AI or biotech data companies. It grounds the whole thesis in a metric that directly accounts for the massive dilution risk you already identified in the bear case.
I see the power in that. It shows the reader that $7 is possible if the company achieves X revenue and the market grants it Y multiple. It ties that aggressive target back to reality.
Exactly.
Okay, that mathematical rigor really addresses the biggest structural challenge here. Now let's pivot from the numbers to the strategic story, specifically that $150 million Bitcoin investment. The material makes a strong case for this being the big story, especially because it was paid largely in Bitcoin. It says this gives them a massive war chest and it validates DataVault's tech because, their tech is about tokenizing real-world assets, or RWA.
The analysis correctly identifies the $150 million investment paid largely in Bitcoin as the big story. But it stops short of explaining the concrete strategic leverage gained by accepting payment in such a volatile digital asset.
Right, and treating the Bitcoin payment only as a sensational funding mechanism, a simple war chest, it misses the opportunity to connect it directly to their operational pivot.
They're shifting from a pretty simple tech product, audio software, to this highly complex, high-risk world of RWA tokenization and genomic data. That is a huge leap. We need to be sure the Bitcoin story actually supports that specific jump.
I wonder if we've considered that the focus on liquidity overlooks why Bitcoin. Why not straight cash or a fiat-backed stablecoin? Why this specific currency for this specific pivot?
If the only benefit is the $150 million, then the choice of asset is a massive liability because of the volatility. The so what is missing.
Precisely. The volatility is the key. Why would you accept a volatile asset unless the asset itself is an integral part of your business model?
So, building on that, the analysis should really elaborate on how using or integrating the Bitcoin itself strengthens the company's competitive advantage in decentralized data and RWA tokenization.
That's the real insight. How does holding BTC actually help them tokenize things?
Yes. The strategic benefit of holding or deploying this specific asset needs to be the focus, not just the capital raise. If the $150 million was just cash, the story is totally different. The partnership is still strong, sure, but that whole digital asset validation claim just falls apart.
Okay.
So to make this thesis incredibly robust, the analysis needs to explore potential, specific applications of that Bitcoin treasury. For example, is the Bitcoin intended to seed a specific decentralized data storage protocol or a lending platform that's integral to their whole tokenizing RWA pivot? Is it required as collateral for validating transactions on a blockchain they use?
I like that. It moves the argument from just passive holding to active utilization.
Or, alternatively, the analysis could detail how holding this specific asset structure aligns with the partnership with Silex in the biotech space, beyond just the liquidity. By explaining the operational, strategic use of the Bitcoin, you reinforce the long-term thesis that the company isn't just raising funds, it's positioning its treasury as an operational asset.
That's a strong point. But let me play devil's advocate for a second.
Go for it.
If they integrate Bitcoin that deeply, doesn't that expose the company to massive, unnecessary volatility risk? Wouldn't that undermine investor confidence? The report has to address that.
It absolutely must. If the analysis can't explain the strategic necessity of the Bitcoin, then the volatility risk becomes a primary bear argument. The strength of this suggestion is that by articulating a clear, operational reason for holding BTC, like needing it for a data protocol, the analysis justifies the risk. It becomes a necessary cost of achieving a unique, defensible competitive advantage. It turns a liability into a feature of their business model.
Excellent. Okay, so it's about justifying the risk with strategic necessity. Now let's talk about presentation and voice. What I really like about this analysis is the attempt to synthesize it into different formats. You have the written report, DVLT stock analysis, the road to $7 starts now, which clearly lays out the growth and the risks, dilution, cash burn, all of it. But then the companion video script leans heavily into this high-octane hype. The title is literally Massive Short Squeeze Coming, Why $7 is Next. That tonal difference, it seems like a potential pitfall.
The shift between the structured, balanced report, the deep dive analysis, and that hyper-aggressive companion video script creates a conflicting editorial voice that could undermine the overall rigor of the analysis. I mean, think of it this way. When you're reporting on a high-risk battleground stock like this one, the primary goal should be to convey the complexity, right? The high-risk, high-reward nature of it. By framing the video primarily around a squeeze and a guaranteed target, you risk alienating the very investors who would appreciate the balanced view in the written material.
It's like reading a balanced prospectus in one hand and seeing a get-rich-quick ad for the same product in the other. It undermines trust. It suggests the author either doesn't fully believe their own rigorous analysis or is just sacrificing credibility for clicks.
Precisely. The lack of consistency undermines the credibility of the entire body of work. You have to maintain a consistent, constructively skeptical tone. So the suggestion here is making sure that the high-impact formats, like the video script, give equal weight to the critical risks that make the stock a battleground play in the first place. Consistency is credibility here.
I agree. We need that balance. But how do you maintain the engagement and excitement for a video without leaning on the squeeze narrative? The goal is still to communicate a bullish thesis.
You don't eliminate the excitement, you anchor it in the risk. To make the tone consistent, consider these adjustments. In the video scripts, the risk must-watch section, dedicate equivalent weight to the dilution and the canceled acquisition, not just a quick mention. If you talk about the revenue growth for a full minute, you need to talk about the dilution for a full minute. Give the risks the respect they deserve.
That raises the stakes. If the risks are presented credibly, the upside potential seems more earned, not just advertised.
Absolutely. And furthermore, adjust the video script's final verdict. to specifically address that $1.70 critical support level and the absolute need for the stock to hold it. This ensures the aggressive bull case is firmly tethered to the technical parameters you already mentioned in the report. It keeps the high energy, but grounds it in technical reality. By tying the bullish argument to the necessity of holding a specific support level, you signal to a sophisticated investor that this isn't just reckless speculation. It's a high-conviction trade based on measurable parameters.
That's incredibly helpful. It reinforces the sense of a cohesive, really well-thought-out piece of research. Okay, to synthesize